Okay, let's catch up on ratio charts. This is one of my favorite watch lists because these are really cool charts. And as I always say when I show these, there's a lot of repetition because there's a general theme you'll see appear, which is bullish on metals, precious metals, and bearish on equities. And so, yeah, just accept it. That's the way it is. So let's go through these. This is Bitcoin versus Ethereum. Bitcoin had been consolidating here for a while, burst forth to quite strong, and then Ethereum had its day in the sun, but that seems to be over as Bitcoin starts to crawl higher, although they're both pretty weak, but this is about relative performance. Here we begin the first of many ratio charts which indicate that precious metals are going to be glorious compared to equities, I think. Certainly acting that way so far. This is the Nasdaq Composite divided by silver, whose pattern is not quite complete, but it's getting there. This is a very complete pattern, which is the Dow Jones Composite divided by silver. So we've cracked this one hard, and from an analog perspective, we're basically back where we were in April 2006 on this one. And it suggests, you know, if we go anything like the past years of more downward push. Here's the Dow Industrials divided by silver, which we have recently cracked. And in this instance, the analogous place and time is also in the spring of 2006. And here again, this thing kept falling for a good 5 years. Here is the Nasdaq 100 divided by the Russell 2000. It has been outperforming for almost 2 decades. Not quite as merciless as before, but it's still, broad uptrend. No surprise there. Back to the precious thing. Here's the Russell versus gold. This cracked way back in January of this year, which is equivalent to September of 2007. And of course, that preceded the last bear market we've witnessed. The last bear market was a full 18 years ago. And so that's an interesting analog in itself. Here's Russell divided by silver. Beautiful chart. In this instance, we've got a rounded up here and a diamond pattern here, but the message is the same. And so this has been absolutely collapsing vis-a-vis silver. Silver's just been on fire. And this is the S&P versus gold. An interesting thing about this is it goes back not as far as the others. This goes back about a quarter century. And what's cool about this is that in real dollar terms, you know, gold as an actual stable currency, we have been in a bear market for decades. And I know that sounds crazy, but it's a point I've made again and again that stocks suck compared to gold this century, this millennium. It sounds bananas, I know, because not every stock is NVIDIA. This is the S&P 500, broadly speaking, and gold has just kicked its butt. So, cool stuff. Here's S&P versus the GDP. Rather lofty, no surprise. This is the S&P divided by, what the hell? I can never quite remember what this critter is here. WM2NS. Hang on a second. Okay, it's the M2 money supply. You'd think I would know that by now, but give me a break. Look at that symbol. Anyway, so it really illustrates the S&P in normalized money supply terms, and as you can see, it's very, 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 very richly valued along the same lines as. And we can change. Let's do a little more obscure slope charts feature here. So if we look at that. It's basically where things were in the tippity top of the middle of 2000 before all holy hell broke loose. And Duke is chiming in with his opinion. Here is the equally weighted S&P divided by the normal S&P, which has been collapsing for years now because fewer and fewer stocks are doing all the heavy lifting. Here's the XOI, which has become kind of a bore fest, but it also looks prone to much lower prices. Sorry for all the barking, but my house is heavily guarded by a black lab puppy. Here is the Nasdaq Composite versus the M2. And this is exceptionally interesting because we are mashed right up at the tippity top of that, and we are above where we were even during the insanity of the internet bubble. That, as Elon would say, let that sink in. I'll just say it again. In M2 adjusted terms, in normalized money supply terms, we are more expensive than the top of the internet bubble. Bleh. So if we haven't collapsed a year from now, something's wrong with everything. Jesus, sorry again about Dookie. As far as Kathy D. Wood, she had her day in the sun here. I strongly suspect this is going to continue to erode away. She had a big breakout here. It's pushed back into this zone. I think the ARK fund is going to be in trouble for a long time to come. XME over GDX. This is going long term as God intended. When it was back up here, I talked about how eventually it would work its way all the way down as it has in the past. It's going that direction. This is gold versus, I think, the CPI. Gold is doing great. No surprise. Gold versus the S&P 500 ETF. Gold is doing just peachy. Thanks so much for asking. Gold versus the US dollar index. Very, very high. And then we get to my old friend Palladium, a real favorite. Palladium versus the CPI is just starting to break out. So I'm hoping for good things ahead on that. Palladium versus the S&P, just starting to break out. Once more, I'm hoping Palladium just glistens compared to equities. I have a very large Palladium position. And then Palladium versus the US dollar, lovely breakout, equivalent to where we were in around May of 2017. In this space, we had a wonderful ascent for a long time to come. Same deal here. Let's do it a third time, shall we? Here is silver versus the spider, obviously doing great. Silver has just been a phenomenon lately. This is silver versus the US dollar index fund, and doing super duper, really just jaw-droppingly well. Akin to what we did with the equal weighted S&P, here's and this is upside down, this is the cubes versus the equally weighted cubes. And as you can see, really, really, really high. In other words, your Googles and your Apples, they're doing all the heavy lifting, and a bunch of those 100 stocks aren't doing nearly as well. And the last one of these, often a favorite, is the S&P 500 ETF divided by the bond fund, and it broke this long-term wedge back here in February, and it's sort of sputtered its way out of the wedge, and I think this is exceptionally vulnerable to dropping hard as the S&P drops faster than the TLT. So that's it. Hope this is helpful and interesting.